All right, so here's a question. What if I told you there's a $150 billion company that most people have never heard of, but it basically runs the behind-the-scenes machinery of modern medicine?
You're talking about Danaher. And yeah, it's one of those names that doesn't get the consumer brand recognition, but if you've ever had blood work done, used a rapid COVID test, or benefited from a biologic drug, Danaher's equipment was probably involved somewhere in that chain.
That's the thing. They don't make the drugs, they don't treat the patients, they make the tools that make all of that possible. And right now they're sitting at a really interesting inflection point. Bioprocessing orders are coming back, they've got a $10 billion acquisition in the pipeline, and the stock is trading about 26% below the average analyst target. So today on Charged Alpha, episode 137, we're going deep on Danaher, ticker DHR.
Let's get into it.
So Danaher was founded back in 1984, headquartered in Washington, D.C. They've got around 63,000 employees spread across 50-plus countries. And the company operates through three main segments: biotechnology at 28% of revenue, life sciences at 31%, and diagnostics, which is the biggest chunk at 41%.
And the brand portfolio is really what makes them special. In biotechnology, you've got Cytiva and Pall. Those are the companies making the bioprocessing equipment that pharmaceutical manufacturers use to produce monoclonal antibodies, mRNA vaccines, and cell and gene therapies. In life sciences, there's Beckman Coulter Life Sciences, SciEx for mass spectrometry, and Leica Microsystems for microscopy. And on the diagnostics side, Cepheid handles rapid molecular diagnostics, Beckman Coulter Diagnostics does the high-volume lab testing, and Radiometer covers blood gas analysis.
Total revenue in 2025 came in at $24.6 billion. And here's the number I keep coming back to: over 80% of their revenue is recurring. That's consumables, reagents, service contracts. Once a hospital or lab installs Danaher equipment, they're buying refills for years.
That recurring revenue base is what gives Danaher its defensive quality. In a recession, labs still need reagents, hospitals still need diagnostic tests. It's not discretionary spending.
Now the big story right now, Danaher announced a $9.9 billion acquisition of Masimo, which is expected to close in the second half of 2026. Masimo is a leader in patient monitoring. Think pulse oximetry, hospital monitoring systems. That deal expands their diagnostics segment into connected health, which is a $50 billion plus addressable market.
And they're doing all of this while integrating AI tools across the portfolio and guiding for 3 to 6% core revenue growth in 2026. So the narrative here is a premium compounder entering its next growth chapter.
Running the show is Rainer Blair. He became CEO in September 2020, so about 5.5 years in the seat. But he's been at Danaher for over 15 years. He joined in 2010 as president of Videojet, that's their inkjet printing equipment division, and then climbed through SciEx, became a group executive, and eventually ran the entire life sciences platform before getting the top job.
What's notable about Blair is that he's a pure product of the Danaher system. He wasn't brought in from outside to shake things up. He rose through the ranks by proving he could execute the Danaher business system, which we'll talk about in a minute. Before Danaher, he was at BASF across 3 continents and ran MAPI Americas. He's also a U.S. Army veteran. The market generally views him favorably, recognized as one of the world's best by WCRC leaders.
And under his leadership, Danaher grew from about $24 billion in revenue, generated $5.3 billion in free cash flow in 2025, and expanded operating margins. Not flashy, but exactly what you want from a compounder CEO.
Let's dig into the financials. Danaher trades at about $199.68 per share, which gives it a market cap of roughly $150 billion. The trailing PE is 40.52, which looks expensive on the surface. But the forward PE drops to 24.33, which tells you the street is pricing in meaningful earnings acceleration.
And on a price-to-sales basis,
6.29 times trailing revenue. That's a premium to most life science peers, but Danaher has historically commanded a premium because of its margin profile and cash generation. Now looking at revenue, full year 2025 was $24.6 billion, up 2.9% year over year. Not explosive growth, but this was still a recovery year from the post-COVID bioprocessing destocking cycle.
Walk us through the quarterly trend.
Sure. Q1 2025 was $5.74 billion, Q2 was $5.94, Q3 was $6.05, and came in at $6.84 billion. So you can see the acceleration through the year, especially in Q4. That's a good sign.
What about profitability?
Gross margin is 59.1%. Excellent for this sector. Operating margin is 19.1%. EPS on a trailing basis is $5.03, but on an adjusted basis they did $7.80 for full year 2025. Free cash flow was $5.3 billion, which is 145% conversion on net income. That's outstanding.
And the balance sheet?
$4.6 billion in cash, $18.4 billion in total debt, but a debt-to-equity ratio of only 0.35. They've got operating cash flow of $6.4 billion, so debt service is very comfortable. The dividend yield is modest at 0.6%. Danaher has never been a yield play. They'd rather reinvest in acquisitions and buybacks. Overall, Danaher's financial health is solid. Strong cash generation and reasonable leverage, just with the caveat that the Massimo deal will temporarily increase debt.
So what are the analysts saying?
Consensus is strong buy, with 26 analysts covering the stock. 20 have buy ratings, 5 hold, 1 sell. The average price target is $250, with a low of $220 and a high of $310. From today's price, that's about 26% upside to the average target.
Any notable recent calls?
3 worth highlighting. Jefferies raised their target from $255 to $265 back in January, citing bioprocessing recovery momentum. JP Morgan went to overweight with a $275 target after the Q4 beat. But then Evercore ISI pulled back in early April. They cut from $254 to $225, flagging tariff headwinds and China uncertainty.
And speaking of earnings, Q4 2025 was reported on January 28th. Revenue beat at $6.84 billion versus the $6.79 consensus. EPS beat at $2.23 versus $2.17 expected.
Clean beats on both lines. And the full year 2026 guidance of $8.35 to $8.50 in adjusted EPS represents solid growth from the $7.80 they just delivered. The street seems to believe the guide is conservative, which is why the stock still carries that premium multiple.
All right, let's lay out the bull case. First catalyst, bioprocessing reacceleration. The destocking cycle that hammered the industry in 2023 and 2024 is ending. Biologics are projected to represent 2/3 of the top 100 drugs by 2030, and Danaher's Cytiva unit is positioned right at the heart of that manufacturing chain.
That's real. The order book supports high single-digit growth with strong consumables book-to-bill ratios.
Second, the Massimo acquisition. If they can execute this at the same level they've executed past deals, they're adding patient monitoring to their diagnostics platform and entering a $50 billion connected health market. And third, DBS-driven margin expansion. They've identified $250 million in cost savings for 2026, which contributes about 30 cents per share. Plus, the product innovation pipeline in AI-powered lab automation is genuinely exciting.
Now, the bear case, and I'll start with the elephant in the room, China. 10 to 12% of Danaher's revenue comes from China, and they're facing volume-based procurement policies that favor domestic suppliers. Recovery timing there is genuinely uncertain.
That's been a drag for a while now.
It has. Second risk, the Massimo integration itself. This is a $9.9 billion deal closing during a CFO transition. Matthew McGrew stepped down in February 2026, replaced by Matthew Gugino. Changing your CFO in the middle of your largest acquisition in years is not ideal. Third, the 2026 guidance is only 3 to 6% core growth. If bioprocessing recovery stalls or diagnostics weaken, there's limited buffer. And fourth, macro headwinds. Tariff uncertainty, FX impacts, and healthcare policy changes all create noise.
Fair exchange. The quality is undeniable, but the execution risks are real, especially in the near term. Let's see how Danaher stacks up against the competition. The 3 big comparisons here are Thermo Fisher, Agilent, and Illumina.
Thermo Fisher is the most direct comparison. They're larger, 44.6 billion in revenue, and trade at a lower PE of 29.25 with 4% revenue growth. So you're getting faster growth at a cheaper multiple. That's the main knock on DHR's valuation.
And Agilent?
Agilent is trading at a PE of 35.47 with 6.7% revenue growth, higher growth momentum, but smaller scale and more focused. Then Illumina is the cheapest at a 22 PE, but they're actually seeing negative revenue growth due to China export restrictions and U.S. research funding pressures. Different risk profile entirely.
So the takeaway is that Danaher commands the highest PE in the group, which means the market is pricing in the DBS premium and the bioprocessing recovery thesis. If those play out, the multiple is justified. If they don't, there's re-rating risk.
Options activity on DHR shows mixed sentiment heading into the April 21st earnings report. The put-call ratio sits at 0.91 based on open interest, slightly bearish. Implied volatility is at the 45th percentile, so moderate, not elevated.
What are the strike clusters telling us?
Call open interest is concentrated around 220, 250, and 260. Those are the upside aspiration levels. On the put side, the clusters are at 195, 200, and 210, which suggests institutional hedging against a 5 to 10% drawdown. The overall read is that the options market is cautiously positioned rather than outright bearish. There's hedging activity, but also meaningful call interest at higher strikes.
Inside the building, the picture is a bit more cautious. Over the past 12 months, there have been 0 insider purchases and multiple significant sales.
The biggest seller was Chairman Mitchell Rales, 437,000 shares worth approximately $95.6 million. SVP and General Counsel Brian Ellis also sold about 22,000 shares for $4.8 million. Now, insiders still own about 11% of the company, so their interests are aligned with shareholders. But the absence of any buying alongside that volume of selling is notable.
Right. Selling doesn't always mean bearishness. Executives sell for taxes, diversification, estate planning, but 0 buys is still a data point worth watching.
3 things I'm watching most closely. First, China policy evolution. Any signal from the Chinese government on easing VBP requirements or reopening to foreign medical equipment would be a major positive catalyst. Second, Massimo integration milestones. We need clean execution and no surprises on the deal close timeline. And third, the Q1 2026 earnings on April 21st. If bioprocessing orders show continued acceleration and guidance gets reiterated or raised, this stock has room to run.
And the key metric?
Free cash flow conversion. As long as Danaher keeps converting net income to cash at above 100%, the thesis holds. That's their superpower, turning earnings into deployable capital.
So here's where we land. Danaher is a textbook quality compounder. The kind of company that may look expensive in any given quarter, but has consistently rewarded patient shareholders over decades. The Danaher business system is a genuine competitive moat. The recurring revenue base provides downside protection, and the secular tailwinds in biologics and diagnostics are real and durable.
The near-term picture is cloudier. China headwinds, Massimo execution risk, and a CFO transition during the largest deal in the company's recent history all warrant caution. But the 26% discount to the average analyst target and the improving bioprocessing order book suggest the market may be pricing in too much pessimism at current levels.
The metric to watch, free cash flow conversion. If Danaher keeps generating $5+ billion in free cash flow annually, the premium multiple is earned. We'll close with this. Danaher CEO Rainer Blair said, "The combination of our differentiated portfolio, the power of the Danaher business system, and the strength of our balance sheet position Danaher for long-term value creation."
That's not just corporate boilerplate. Those 3 pillars, portfolio, system, balance sheet, that is genuinely the investment thesis in one sentence. Whether the market rewards it this quarter or next year is a different question, but the architecture is there.
Well said. That's going to do it for episode 137 of Charged Alpha, our deep dive into Danaher Corporation, ticker DHR. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
Links in the show notes.
Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.